banks are playing an interesting game. They're not trying to typically pick the next Apple or OpenAI or SpaceX. A lot of what banks are doing is using venture debt as customer acquisition financing to bring in people they hope to work with for the duration of their lifetime, which might be well beyond the actual time frame of the venture debt or the capital they lend, which is sort of different than what venture capital funds are doing, where they're trying to pick winners. So they're going to be evaluating how much money the company's raised, who did they raise it from, what do the historical financials look like. But a lot of the focus from a bank is just going to be, do we think this company is going to be able to access additional equity capital in the future, which is really what is going to help pay back the debt they're going to borrow.
Marshall, welcome to Tech Scenes Unplugged.
Thanks, Jeff. Appreciate being on.
I'm excited to talk. You have a very interesting book coming out, and I'm very excited to see this get out there because I think it's really important for a lot of people to understand venture debt. I know it's new to some people. It's maybe not new to others, but there's a lot of nuances behind it, and you wrote a book on it, and I think it's really important that people learn these nuances because I think it could really unlock a lot of important capital into organizations for the right organizations. And, you know, we only have so much time, energy, and capital. And those are one of the things that it's really important to unlock in organizations that are doing things that have never been done before. And so I'm really excited to talk about this. And, you know, why don't we start from the top and tell me about the book?
Well, the book's called Venture Debt Deals, which is a play on a book that a lot of people in the innovation economy will know and have probably bought. I've got several copies in this office where we're recording Venture Deals by Brad Feld. And someone you know well, he's been on your show a couple of times. Founder Group, general partner, longtime blogger, author of, I think, 9 or 10 books. But he and Jason Mendelsohn wrote Venture Deals, released it, I think, originally 2011. Really opening the black box of how do venture funds operate. You know, what's a venture fundraising process for entrepreneur going to look like? What's going to be in a term sheet? You know, very specifically detail each section. I think at the time that really wasn't something that most entrepreneurs had, you know, a lot of access. There wasn't a lot of transparency into that part of the fundraising process they'd have to go through, and a little bit of asymmetry, actually a lot of asymmetry, where venture investors would do hundreds, if not thousands, of evaluations of companies and sort of term sheets issued. An entrepreneur might do that on one hand across their career. So you really had kind of an imbalance in that book. At the time, I was at Silicon Valley Bank, SVB, my former employer, and it was sort of a seminal work for entrepreneurs, but also people in the industry. Sort of continued on. It's in its 4th edition. I think 14 years in, still a top-selling book on venture capital, sort of required reading for entrepreneurs. So back to my book, is sort of the venture debt version of Venture Deals, where I walk through sort of what is involved in a venture debt fundraise, who are the participants in the ecosystem, how do they make decisions, how do they evaluate companies, what's going to be in a term sheet, you know, the specific detail of those components, what are lenders thinking about in the background, some of the nuances after SVB's sort of failure in an acquisition, which I got to participate, actually straddling 2 countries while working for SVB in Canada, and then including some case studies, maybe a little bit different than Venture Deals. My book has some case studies of companies that I was fortunate enough to lend money to, some good outcomes, some not so good outcomes, where we sort of talk through the specifics of a process in the real world and sort of how things turned out.
I would love to talk about all those things, and I think it would take us a long time. So good thing that you wrote a book on it so people can read it all. What really flipped the switch for you to be like, I'm going to leave banking, I'm going to leave SVB and write this book and become an author?
Yeah, I spent more than 2 decades in the venture banking and venture lending industry. Most recently, 16 of those years were at SVB up until March of 2025. And much to my wife's delight, I left a good paying job at a good firm to become a unpaid and at the time unpublished author, which is always an interesting leap. Back when Venture Deals came out in 2011, sort of that year when I read that book, I was like, oh, there should be a venture debt version of this book. I'm not sure I was the right guy to write that book at that point, which is why I didn't really do anything meaningful. I did sort of plink around with a few chapters back in 2012, 2013. But again, probably wasn't the right time for me given experience level. I didn't have I wasn't quite as bald and didn't have quite as much gray hair at that time. So, decided not to really pursue it. Also, when you have a day job, it's tough to write a book. Not to mention if you're writing a book at a bank, the amount of lawyers involved who will review that book before it ever gets out is beyond what I probably wanted to navigate. Fast forward to 2024, into 2024, I had our second child in our family, was on paternity leave. So you think about what you want to do next or potentially different. And then actually went to a conference called the Lobby Conference that I've been a regular participant, actually a sponsor, a lead of the sponsorship at SVB. The Lobby Conference, if you don't know it, is David Hornick and originally the August Capital team. Now they're the Lobby Capital team.
Right.
He did the first unconference 20 years ago where the joke was, and the reason it's called the lobby is that you'd go to a tech conference and all the best conversations actually happened in the lobby and the content didn't matter. And so he built a conference around that and it's been running for 20 years. It's awesome. A bunch of great humans having interesting conversations. That's kind of what it is. A bunch of facilitated conversations by attendees. One of those conversations I sat in October 2024 was with Sarah Lacey. I don't know if you know Sarah Lacey at all.
No.
She, longtime investigative journalist, created and co-founded the site Pando Daily, which was sort of like a mix of TechCrunch and The Information. She's written 3 books, pretty opinionated in a good way and inspirational person. She gave a talk about how to consider writing your first book.
Okay.
And me and actually 2 other members of that little conversation in Hawaii, which is where the lobby is, Heart Life, all decided to start writing books on the heels of that. So that's what really got me off the fence, sort of started doing it on nights and weekends in early part of 25 and then left at the end of Q1 from SVB in 2025 to do this full time, partly because, again, day job, it's really hard to write a book.
Right.
Legal review of a book of any type when you're writing it in a corporation is going to be more robust than it would if you're not. And then most importantly, and the thing that I was really focused on leaving SVB, who I still think very highly of as an institution, a book about venture debt like Venture Deals, I don't think has quite the credibility if you're employed as the author at a lender while doing it, right? It's just going to be a question of like, is this a marketing or a puff piece or whatever? So felt it was important to leave and be an independent sort of voice who could say, whatever. I wanted good, bad, pros and cons of everybody who participates to make it, I hope, the most useful for target is really the entrepreneurial founder community who's going to have to navigate what's the right way to capitalize their business across their entire life cycle, which I'm sure you've had to consider as well, Jeff. But if I've done it right, I hope both it's useful for them as well as, frankly, other people, including lenders and lawyers and others, where everybody, like Venture Deals, maybe is at a more even playing field when they start a conversation about, in this case, venture lending, but generally how to just capitalize the business. And then everybody benefits from that, right? Like entrepreneurs and boards, are more informed in general about how this industry operates. The people participating on the lender side actually sort of have a better, counterparty in the sense that they don't have to do a bunch of education, which is frankly another reason why I wrote the book. I had to spend all kinds of time across my career in all kinds of places and roles explaining to entrepreneurs and board members and you name it, participant in the innovation economy, what is venture lending? How should you approach it? When should you not use it? When is it not the right tool to pull out of the toolkit? Where is it great, to use, and all the things in between? So that was sort of the hope at the end, is that this becomes makes everybody's life a little easier when they go to try and capitalize their business.
Yeah, I think it's a often misunderstood option. Looking back, not to date myself, I've been helping venture teams, high growth teams since the 90s. And back then, and maybe you can give us a little history of how this type of banking evolved, but banks wouldn't touch you. And maybe I'm wrong, but a lot of the banks that I talked to or helped teams with, or I felt like they really struggled in those days, early days of looking for banking options and funding options outside of venture capital. Was that true, or what's been the history of this?
I think that's a very valid take. Venture lending and venture debt, and then banks who are providing that, that's been around for almost 40 years, but it's a very, up until the last, let's call it 5 years, maybe 10 if you go far enough back, like it's been more of a cottage industry, sort of like venture capital, frankly, like venture capital dollars deployed and sort of who were the participants. If you go back to the 90s and earlier, there was not a big roster, and the dollars deployed was certainly well below what you see today, where, venture capital and, startup land is sort of everywhere. It touches every part of the economy. Sort of the original players in this space, you had Comdisco doing venture leasing, which was equipment financing for startups, servers, whatnot. A little bit of a cousin to venture debt. WTI is sort of the original private credit fund who did venture debt. They got two names, WTI and Venture Lending and Leasing is what they were also known or continue to be known as. They were in the early 1980, 81, I believe is when they were founded. And then SVB was founded in 1983. Both were sort of providing venture debt. Private credit was providing more. WTI was providing more of it. But SVB started back in 83 to sort of solve the problem you were talking about, where actually the founders of Cisco coming out of Stanford couldn't get a bank account. And the guys who started SVB sort of did that because they were trying to help the husband and wife who were founding Cisco. But even into the 90s, there was just not, SVB was still not the thing it was for the last 10 years up until March of 23 and then continues on today. But there were still not a ton of options for people to get good banking, just basic banking services for a startup, because those startups they're the antithesis of a normal commercial banking client, where no corporate history, they have minimal assets, they're losing money and may lose money for years, if not ever. All these things that are just the opposite of what traditionally commercial banks thought of as viable businesses to work with. Even in the late 90s dot-com bubble and then bust, SVB was kind of the player. Comerica Bank, actually where I started my career, they had a tech practice by buying Imperial Bank back in that time frame. But there was a couple options, and that was kind of it. And even what SVB and Comerica offered at the time, you could argue was not what it is today, and what the litany of players who are willing to work with startups, because everyone realizes that just because you don't have the perfect profile to start, the potential of companies that you've worked with, Jeff, and others, there is the potential to work with, companies that change the world if you are willing to start that early. And there's a difference between what is real risk and perceived risk in startup land. And a number of banks and a lot of private credit funds have gotten a lot better at deciphering that difference. Let's
back up a little bit. If you were to be asked, not an elevator pitch, that time frame, not 30 seconds, but like in a minute and a half, I'll give you in 96 seconds, Marshall. That's good.
Noted.
Venture debt 101. Like, how would you explain it to someone? Say it's a CEO, founder, they're out there raising money. Maybe they're in between the seed to Series A stage, and they've heard of venture debt. How would you explain it to them?
Venture debt is ideally meant to extend a runway and allow a company to get a little bit further on the combination of equity it's already raised and the debt, such that it can achieve a milestone or milestones that are going to help drive a meaningful step up in the valuation of the next equity financing that company's going to raise. The benefit of doing that, is that you as an entrepreneur or founder have the potential to have less dilution and more of the company stay in your hands, as opposed to others, including your employees and existing shareholders get the benefit of less dilution. Venture debt is typically a term loan that runs out kind of 3 to 6 years. At some point, it starts getting paid back, usually over a straight line basis, sort of like a car loan. On balance, the cost of that debt is significantly lower than the equivalent amount of venture equity you might raise.
So the next question would be, if you're a CEO or a founder, is like, what's that going to cost me? And the interest rates must be crazy on something like this.
Depends on when and how you raise the money, and which players you involve in the conversation. Maybe taking one step back for a second is just to talk about really the two major types of participants in venture lending. One is banks, like SVB, my former employer, Comerica Bank, where I started my career. A number of others, HSBC, Stifel, JP Morgan are in this industry now. They want to be your bank in addition to your lender. And more importantly, the way that those institutions finance their lending is by sort of banking 101. They take deposits from companies that are using their banking platform and then use that money to lend out to companies that they work with who need the money. And on balance,
they want that $25 million raise sitting in their bank.
Exactly. They're going to take, and this is how all bank lending works, right? You're taking deposits that you have and lending it to from customers, and then lending it to customers who need to borrow capital. What that means is that banks and how they operate and sort of their business model is different than the other party, which is private credit funds. Private credit is people like a venture fund who have raised external pools of capital from limited partners. Some of these firms are fully private. Some of them are public, and you can actually invest in them as an individual. They don't do any banking, so they don't have to worry about providing those services, but they don't get the benefit of a lower cost of capital themselves. Taking money from limited partners is going to cost more versus deposits on the banking side. So in general, banks will be less expensive than private credit funds. Banks, however, tend to do lower dollar amount on average venture debt deals. Private credit funds tend to be ones where they show up when companies need, tens of, usually more like $50 million these days on the USD on the low end, up to, $100, $200 million on the high end. So really big chunks of capital. Lower volume from private credit funds. Venture banks do a ton of deals, typically between sort of $0 and $30 million of venture debt. All these numbers have changed meaningfully over the last 5 years in particular, as interest rates went up, and SVB had its moment unfortunately in the spotlight in March of 23, and it's certainly continued on as an institution, but that sort of changed the dynamics. Back to your question on economics. As we're talking and sort of in early 2026, when this will be released, is the market is the least expensive when you're a Series A, Series B, Series C company wanting to borrow, call it $0 to $30 million, primarily from banks. Right. So that's going to be typically some form of interest rate on the borrowed dollars, somewhere between, if I had to guess, most banks should be somewhere between like 7 and 9% interest, usually based on Wall Street Journal Prime with a margin. There's usually a fee on the front, a fee on the back end of the debt. And the most consequential cost, if you will, is the warrant that a venture lender will ask for. It's not, venture debt is not non-dilutive capital, or it is minimally dilutive capital. Most warrants are going to be well below, 1% fully diluted ownership that a lender is going to ask for, but it will range depending on the cap table valuation of the business itself. For these Series A to C companies, that's probably somewhere in the like 10 basis points to 50 basis points of ownership. That's the most substantive, probably, cost most entrepreneurs are going to key up on. If you want to borrow money earlier than that, if you're a seed company going into Series A, there are players who do that, both private credit funds and some banks, small number. That'll be more expensive than what I just said. Yeah. And then on the other end, where you're doing really big chunks of capital from primarily private credit funds, though there's a few banks that play in these bigger structures, also the economics get higher. Usually there's always the same components. There's an interest rate, some fees, and a warrant, but those numbers get a lot more substantial on either end of the barbell, if you will.
Yeah. I have a lot of teams in that A to C range, and tell me a little bit like how it's underwritten, and is there milestones to unlock further capital?
Short answer, as you'll see, if anybody reads my book, I have a lot of it depends, because the situation is usually bespoke to the company, though there is a general framework you could think about. Let me take another step back quickly, just talk about banks and what they're doing, which is most of if you're talking about sort of 0 to 20, 30 million venture debt, that's going to be mostly banks playing in that space. Banks are playing an interesting game. It's not what you might think. They're not trying to typically pick the next Apple or OpenAI or SpaceX, at least initially. A lot of what banks are doing is using venture debt as customer acquisition financing to bring in people they hope to work with for the duration of their lifetime as an entrepreneur or as a company, which might be well beyond the actual time frame of the venture debt or the capital they lend. So they're really thinking about, what do we need to do to get this company in the business? And is this company that we're lending money to going to be able to raise additional equity in its next round, which is really what is going to help pay back the debt they're going to borrow.
Right.
Which is sort of different than what venture capital funds are doing, where they're trying to pick winners. Private credit funds, and as deals get bigger, you're getting a lot more closer to, we're trying to pick the winner or the company headed towards a really good outcome. You're also typically the later stage companies where you can do a lot of comparables to public market numbers and whatnot. But banks are generally going to be thinking about, how do I bring this business in? So they're going to be evaluating a variety of things when they look at a company, and they're not all that different than venture capital. You're going to look at the team, the market, how much money the company's raised, who did they raise it from, what are projections saying the company's expecting to do, what do the historical financials look like. But a lot of the focus from a bank or lender at that stage is going to be, do we think this company is going to be able to access additional equity capital in the future from outsiders or the existing cap table and existing investors, that is going to basically de-risk our debt.
Yep.
And so a lot of the time and effort will be spent around, understanding the business, looking at the projections, because that's important, but also everyone jokes that the only thing you know about projections is they're wrong, just a question of which direction. But a lot, probably a key area of focus is going to be around just, who are the investors involved? Have we worked with them before? Have they done what they said they were going to do? Almost irrespective of the company itself, you're sort of evaluating the investors around the table. But that's where a lot of that time and effort is going to be spent with that type of company that you just described.
I think it's really important for CEOs, founders, COOs, CFOs to understand that dynamic of what these banks want and what they're looking for. On the flip, from their perspective, operating an organization that they're actively trying to grow, again, from the CEO, COO, CFO type office view, where does venture debt make the most sense in a company, for a company, and where is it clearly the wrong fit?
Just like venture capital fundraising, raising too much venture capital from the wrong parties can royally, and I can't remember if you're a G-rated or an R-rated podcast, but they can.
You can do whatever you want.
You can royally fuck up your business. Same thing with venture debt, and a number of unique things you have to be careful with venture debt, because lenders can take sort of faster action than an equity investor might, even if the outcome is your company gets hosed either way. Like venture lenders, you got to be careful with. The place where venture debt in general is going to be the most useful, impactful, appropriate, and it's the subtitle of my book actually sort of keys up on it, which is how to fund growth with less dilution. So for that to be true, where I think venture debt has the biggest impact and where I've seen it across the portfolio companies I was fortunate enough to work with across 20 plus years, is where things are working. Companies have line of sight to meaningful milestones of progress. Customers are in the pipeline and they're kind of reliably converting. And the company wants to get that much further to achieve those things or whatever it is that they're keyed up on over the next 18 or 24 months. Because their equity is getting close to burning all the way down, and instead of raising an immediate equity round where they might actually successfully be able to do that, it's not a question of being able to access the capital. It's just that the valuation you're going to get from outside investors now or in the next 6 months versus raising that same round 18 months from now would be potentially a step function different. And, those things, again, if you can save 5 to 10% of the ownership in your company, as opposed to giving it to investors unnecessarily, right, if you turn into a billion, multi-billion dollar company, that's meaningful dollars. And again, that's not just the founders, though that's obviously important. That's all employees, everybody who's got ownership in the business, including existing shareholders who could be the existing, investors, minimizing dilution, not just for optimizing that, but minimizing dilution while helping to finance the continued growth of the business is why I think venture debt is at least a tool to know about. Whether it's the appropriate thing to use in every case is a wholly different question. But that's where I've seen it used. And that's where I'd say that's where most people should spend time debating when and how should we use this form of capital alongside equity. The flip side of that coin, and you asked about sort of where is it not applicable. The places that I've seen, probably the place that I'd say is the most red flaggish is if you don't have as a company any kind of semblance of what the capital is going to be used for. Meaning like, I just want extra time. We don't know if things are really working. In fact, they might not be working, and we want to delay the inevitable and borrow money to see if we can figure it out. Are there lenders who will do that kind of financing? Yes, there are. Have I seen a lot more companies have problems with the capital they bring on from lenders in that type of situation, either because the company just doesn't work out or the lenders get antsy and start taking action? Like, it's substantially higher that's going to lead, that kind of situation is going to lead to a bad outcome of a variety of types. It doesn't always, plenty of companies have survived that and not had a problem, but if you don't really have enough data points in the business, not that you need to know you're ultimately going to be successful, but you need to have concrete things ahead of you that this capital that you're bringing on from lenders is going to help you have the time frame to achieve. And most companies don't hit exactly the time frames they're laying out for those milestones either. But again, you need to have sort of a well thought out use case for the dollars. Otherwise, I think just the odds that you have a problem down the road are meaningfully higher.
I don't know if I led you to this point on purpose or that all I think about is how to operate. But sure. I think it's really interesting because you get calls from on the venture side of looking at teams and saying, are they equipped to operate? Right. I mean, my background's really in how do you create teams that operate specifically in a world where there's no blueprint, and you can have the best people, you can have the best opportunity and fail at operating. And that's why I think people will say, execution is everything. Mm-hmm. And I do think execution is everything. Even planning is part of execution. But I do think it's interesting from a bank's view, what they're looking at to qualify this company. And it comes down to if this relationship is going to be successful is if they can operate, if they can set up the right objectives and goals and go out and, accomplish them, iterate on them. I think it's really important. And also on the flip side, if I take on venture capital, I take on venture debt, it's really imperative that I hit these milestones that we're going after and doing. And it's true on both sides. I think it is interesting, oftentimes I think it's underlooked at looking at an organization and a team and if they're equipped to operate or not.
Yeah.
And there are BC talent with a BC idea that can operate that will outpace a team of A players with a great idea that can operate. I see it all the time. I think it's really interesting. Again, I did not try to lead you to this, but maybe that's just my view on things.
I bet you have an interesting lens into sort of how you would evaluate a company's or a executive groups or a founding team, like their ability to operate well. Venture lenders are certainly trying to, not at the depth you might imagine. I bet you've gone into bigger depth, and certainly venture capitalists go into bigger depth on this because venture lenders tend to get the benefit of the, whatever your opinion on VC diligence is, insert your joke about VCs here, but venture lenders get the benefit of the equity investors having evaluated or maybe worked with these entrepreneurs before that you're using. Right. Not that this means the company will be successful, but the people involved at least maybe have the credibility, technical skills, execution back, ability to execute, sort of that's cleared a bar. So venture lenders aren't looking at that as much. What I'd say that most venture lenders are doing when they go and meet companies and founding teams, probably three things really. When you meet in person, by the way, what most the lenders are doing is the first priority is like is this a fraudulent business check, which is sort of
Right.
the which it doesn't happen really all that often in venture-backed company land, but it
Right.
does. And actually, increasingly after COVID, it's happened a little more higher clip. But you sort of meet teams in person now, and you want to say, is this a real human in a real office, and is any of this striking me as fraudulent? Most companies pass that test. But the other two things you're looking at is, do I think this founder, CEO, if you're meeting with the founder and CEO or even CFO, whoever it is, this most senior person meeting with, do I think this person has the skill set technically, but actually more of like the soft skills? How is this person going to inspire an entire team to do really hard things when a lot of data may be saying it's not, working or perfect? I mean, this is sort of startup plan 101, where everyone's running around with their hair on fire all the time. Things are not going to work. And can these people motivate a broader team? You start thinking about that. And actually, what lenders actually look at a lot is if you got multiple members of a founding team or executive team together, do these people like each other, or can they function well together? And most of the time people pass that check, but occasionally you'll pick up on, and I'd be curious on your end of how you've evaluated teams in a second, but you'll pick up on like, these guys hate each other. And like one is trying to step on the other immediately after they stop speaking, and maybe that can still be an okay thing, success, but like more often than not, that's going to be some pain in the near term of people that, divorce each other in the corporate sense. So you sort of pay attention to all those things, and lenders get the benefit of just pattern recognition, talking to lots of people, just like an or investor or a VC firm with a lot of volume or velocity, where you can see like, wow, this is not normal, either good or in this case bad, where people are just clearly not a high functioning team, which most cases is going to lead to not a executing team. So, but I'd be curious, is there other things you've evaluated people on, or like what's your litmus test for high functioning or not high functioning teams?
Yeah, I have a very specific methodology on it. And I'll narrow it down to like the 5 behaviors of all high performing teams. Is symbiosis. Are they working well together? Do they have the desire and intention to work well together? Which you were kind of saying, like, right? Sure. There's a difference there, and that matters. Sure. Some teams you can tell they're not trying to work well together. So it's symbiosis, communication, and there's a lot of realms of communication. But most teams that have bad communication, they think they solve that by having more communication, which they end up with is more bad communication. But a cadence of communication, asking the right questions, loops and solving problems, alignment. Are they truly aligned? And I think it's always funny when people talk about time. They talk about like buying time. You can't buy time. Time is linear and doesn't stop. All we really have is resources, which you can throw capital in there, and energy, right? Mm-hmm. That's what teams have. And then there's a specific timeline, and time just keeps on going on. As we're recording right now, there's a little timer up there, and that timer never stops, right? Like, so alignment around specific time frames, which I think bankers would like, and especially underwriters, is what are we going to accomplish on this timeline? And how are we going to take this capital, our resources, and our team only has so much energy to accomplish those things. And so I think alignment is really important, because once you can define where you want to go, then teams have the opportunity to figure out how they're going to do that, who's going to do it, and get the details of that. But teams don't do that on a timeline. That's where most arguments occur. Mm-hmm. People are saying, hey, we should do this. And then you have 2 co-founders arguing, or maybe it's product and engineering arguing. And then you say, we should do that by next year or tomorrow. And they're both like, oh, next year. Now it's not an argument. So aligning on a timeline, I think, is really important. So alignment, and then learning. You have to have a learning loop in the company, especially companies. We're talking about venture debt, venture capital. These are organizations that are doing things that have never been done before, right? And so the organization itself is a million scientific processes happening all at the same time. It's a bunch of people trying to figure things out, learn from it, take that learning, modify what they're doing. And if they don't have that ingrained in them, or they're hiring people that are maybe very corporate-y people that are used to just knowing what they're needing to do and just operating and not learning and operating, that's where things break down. And the last one's empowerment. Once you have this all set, you have to empower your people just to run. And having all those things set up. So at the highest level, and I have a very specific methodology to look at teams if they can operate or not. It comes down to those 5 behaviors, and if the teams are lacking those behaviors, you can scale them up and fix them. But if the team really doesn't understand those behaviors, it's very likely they're going to fail.
I think you're getting on. I mean, just generally, people think, oh, businesses, startups, best technology wins, or a lot of it is about how do you, build and scale the fastest. And, that's certainly true to a degree. But at the end of the day, what I've certainly come to appreciate of my 20 plus years focused on this industry, and also coming from a family where my father was an entrepreneur and an investor at some points in my life, a lot of this just comes down to the people involved and how well or not they can function together. You have to have a good idea in tech and everything else, but like the human-to-human interaction, the ability of those teams to function well, which then leads to the execution you're talking about. And execution is really everything, as opposed to like idea. Everyone can have the same idea, but the person who executes on it matters. But a lot of this just comes down to the humans involved. So a lot of what I think you're probably doing in your work, lenders do, investors do to a large degree, is like, okay, can all these humans already function well together? Do we believe they can function well together? Do we believe they can inspire other people to come and do something crazy for years with no guaranteed success? I mean, all that is just down to who is the person across the table.
I see some medals hanging in the background. Have you played sports? Been part of teams in athletics?
I have. I've played soccer at a pretty competitive level most of my life. I played ice hockey later in life. Thankfully, I have all my teeth still. I played it poorly. I was a late participant. I do a bunch of Olympic lifting and sort of CrossFit style working out now, and some occasional running and cycling. So yeah, I do.
So you probably have been at one point in your life been on teams that were not good teams, and teams that are excellent teams, and you there's a difference, right? You can feel the difference of the two, right?
Psychological difference of how how motivated you are, how you're going to interact with each other in those different dynamics is huge.
Yeah.
If I recall correctly, actually, Jeff, you got your own professional background, but you're wrestler, jiu-jitsu guy, if I recall correctly. Did you do team sports at any point?
I played hockey growing up as well.
I coached hockey better than me, if I had to guess.
I coached hockey for 15 years. I've coached wrestling and jiu-jitsu. But like using the analogy of, let's say, soccer and being if you played that pretty high level, it just doesn't, you don't just throw a bunch of good players on the field and you play. Like, everyone knows their role, right? And they have a very specific role, and someone fails in their role and someone has to come in to solve that, then it leaves another gap probably on the field, right? So everybody knows their role, playing their role, and there's a system behind everything, right? And so I think high-performing teams in business are the same way. We all really need to know what our role and our lane, and if something fails, what gaps are we going to give up? And that there's a system that we have to ensure that we put the ball in the net, right? And I think, a lot of teams that are kind of winging it haven't thought of it that deeply about that. Not that it's actually that complex or challenging to put it together, but like, those are the teams, the ones that have that put together or have intention to do that are the ones that succeed from an operational standpoint. The ones that just try to get the best people and see where this thing goes. Again, they could be A players with a idea and lacked execution, and it will fall apart.
100%. And I think, again, venture lenders, just like venture capitalists, if they are good at what they do, there's obviously a spectrum of, good, mediocre, bad, venture capitalists and venture lenders. But the best ones will be looking at, teams that they work with, some of the pattern recognition they get from other parties, and sort of getting that sort of gut feel of, do these people have the ability to function with each other? One of the best examples that actually I wrote about in the book is when I worked with Airbnb for a number of years, provided capital pretty early on in their life cycle. And they ultimately borrowed actually a lot more money during COVID from some other big private credit funds because the business was potentially going to die. Credit to Brian and the team at Airbnb for not only surviving, but sort of thriving. But going back to like the early 2011, 2012 timeframe when I was working with the company, and you walk into their office in the sort of Soma area by the Caltrain station, if you know where that is, 888 Brannan, and their Rhode Island office as well. You could just feel a difference without having seen any of the numbers of the business yet, even though we knew they were doing well. It was sort of one of the early unicorns when that was not a term that is just bandied about these days. The difference in what and how that office felt when we went in there to meet people, they passed the fraud check immediately, which was good.
Yeah, of course.
But just genuinely, like, I don't know, like everyone was just stoked to be there. And maybe that's because they were part of an early rocket ship ride of a business. But I don't think I've been to other companies that had that same level of performance over the years, and some of them felt terrible, and like people hated their job, even though the company was doing well. Airbnb was justified that people should be excited because the business was ramping. But I think Brian, Joe, and Nate sort of had built a culture that I think continues this day of like, it's a really high functioning team and culture and business that excites people when they're there, motivates them. I mean, all those things, and you can feel the difference relative to other businesses. And yeah, that's one of the most stark examples I can think of in my career where, wow, this is very different. And these guys are jamming on top of it or contributing to it probably. But it felt very unique there.
They are a good example of a team that has really the intention to operate, right? The intention to be a good team and doing what is needed to do that. And sometimes those are hard decisions, but like sometimes they're easy decisions, but have the right intention. I think it leads that. In the book, what did you write about that you're like, oh, I'm so glad I put that in the book, because that's just something that people don't know, people need to know. I'd love to hear what you think was kind of left out and that this book is filling the gap for.
Well, in general, sometimes it's also hard when you spend 20 years in the industry. Everything that you think is just sort of base level knowledge that I know is not anywhere near that level of known in the industry about how venture debt and the lenders who provide it, function. So I think there's a little bit of what we've already talked about. Like, who are the different parties? How are they motivated? What are their business models? What are they trying to achieve? That'll maybe be eye-opening to some people, maybe not. Sort of what I put in there at the tail end of the book, sort of the back third, is after we talk about the term sheet and the specifics, which I'm sure will be useful to people, I hope, at least if I've done a decent job writing, is how do you build a working relationship with your lender that is going to go beyond just the capital they provide, or on top of just the capital they provide, make sure that you get the most out of them as a company and a founder? Because I think a lot of the executives, founders that I've come across over the years, at least start from a position of this bank or this fund are kind of a service provider, maybe not thought of exactly as, I don't know, a strategic partner, peer level. Those who I think do venture lending well over time really earn that right to where a founder thinks of them, the first person they might call might be their lender just because they're that good at what they do and touch the ecosystem a lot. But I think a lot of people think of lenders as a little more in the service provider land. And I think that's the wrong way to approach it from the company perspective, both selfishly, because if you build a really good working relationship with a lender that does good work, like that can pay dividends both in the type of capital and flexibility you'll get, but actually there's a bunch of stuff beyond that you can get out of a lending partner if you are intentional about it, back to intentionality, and you put work into building just a good human to human relationship that creates trust and everything else. Like there's a ton of stuff you could get that will benefit your company. And, I sometimes provided and sometimes was spectacularly bad at providing depending on the context. But, there's a lot of great examples I can think of across my career with colleagues and even other firms that were competitive, like who sort of went above and beyond to help their portfolio companies. But they usually only do that when you've built a really strong working relationship with that party. So that's, there's a bunch of, I could talk about some specifics there if you want, but like there's a whole couple of chapters on like, how do you build a better working relationship and get more out of your lender than you would otherwise, just beyond the capital they're providing, which is important.
Right.
But
Right.
that's, you hope, sort of table stakes that you get to a place where you get the capital you need.
Yeah. Well, that really connects to like how would someone choose the right venture lender?
As I said before, the short pithy answer is it depends. On depends on the profile of the company. It depends on what they're trying to achieve. It depends on how much capital they're trying to borrow, because who would be the right, at least, category of partner, type of lender, situation the company finds itself in is going to vary who you might want to actually take money from. Sometimes, you might be in a situation where a company is in the, I don't have all the great use case info I described earlier, but they still want to borrow capital, and you have to go talk to what you might call
Right.
the lenders of last resort category. You can still get a great partnership and a great, deal done, and that could be beneficial to everybody. So that might be a different way you pick a lender.
If you were put on a CEO hat or a CFO hat, um, knowing what you know, what would be like the top three questions that you would ask when you'd sit down with?
Let me do one step back, in that I would encourage every CEO founding team, if they're going to think they need venture debt at some point or in the near term, it kind of be building relationships like venture investors you might do, where you're not fundraising, but you want to talk to people, just so you've got to
Yep.
work. You're not just immediately showing up saying I want money. That can help make a process that much better for people. You don't want to talk to too many people. Sort of 3 to 5 at most is probably the number that you want to go talk to, at least in the venture lending. That could be a much bigger number in venture capital land. How long have they been in business? Longer is generally better. Just because someone's been in business a long time does not mean they're going to be a great partner, but it's generally a good indicator, because you want to know, have they gone through a market cycle yet of the market going up and down? Post SVB's failure, there's a number of new entrants in the space where they've got some really skilled SVB alumnus that are there. So maybe the firm hasn't gone through the same duration and life cycle of the venture market, but the people involved have. So there's some interesting nuance and evaluation, but just sort of understanding how long they've been, how do they sort of approach working with their own portfolio companies, sort of what's a good fit for them. The people involved specifically. So the firm is one thing. How do they approach working with companies? And then the third thing would be just, who are the people you're working with? Are these the more tenured members of the organization? Is it more junior? How is this going to move forward? Am I going to be handed off to a different team when the deal closes? Some people have BD folks that will hand you off to a team after the fact. All of this leads up to, frankly, you as a company doing your own evaluation, assuming a lender provides you a term sheet with capital that makes sense and the terms work for you. Again, that's very situational, hard to tell people exactly what that is. But you should feel like, I have a good working relationship with these humans, and I want to spend, just like venture capitalists, you're going to get married to the people on your board. It's not quite that level of commitment, but you want to make sure that the people across the table from you at your lender are people that you can trust, that you think know what they're doing, that you've already got a good working relationship with even before the deal closes. Because if any of that's in question before something, is, signed, it's not going to get probably better if you now have a bunch of legal agreements and a lender who's got a bunch of rights and controls. Like, you want to be in a place where you feel like this is a good team and set of humans
Right.
across the table. It's not unlike what the lenders are doing about the company. So that's not the most specific thing in the world, but I think most people would probably feel it if they talk to 3 to 5 firms in an evaluation process. There'll be a difference of approach, and there'll be different people, asking smart questions, dumb questions, people you'll like, people you don't like, all of that. I think more often than not, the success, aside from making sure you get the right capital for the right use case, the success of a relationship between company and lender is going to come down to the humans involved. So, making sure that you feel good about the people across the table.
Yeah.
We're going to be providing the capital.
2 questions left. The first one is a multi question. So it's really 3 questions left for you. If you could sum up what happened with Silicon Valley Bank, SVB, what really happened and what didn't happen from people's perspectives. Yeah. And then the second part of that question really is the new venture debt landscape. Like, where do you see it going post SVB? I'd love to hear a little bit about that.
Well, it's a case study in the book on SVB as the lived experience as a fairly senior member of of the organization. I was again straddling as the token American involved in helping build SVB Canada when the bank failed. I was straddling, an international border between Canada and the United States, which was interesting if I can remove myself from the emotional turmoil and pain of the whole thing happening, but certainly a unique position. SVB, first of all, did not fail because venture lending is bad, or the firm didn't know how to lend money to startup companies, and nor do others. Like that's not. Some people sort of equate that venture debt was the cause of SVB's failure. It was not, and I could point to a bunch of data points that would prove that to you. But I just take me at my word there for a second. What SVB did very poorly at the very senior executive level was banking 101. You have to make sure that the institution has enough liquidity to fund all the things it needs to do, which means you can't take deposits from all the startup companies we were working with at the time and then put them into long duration bonds, which is what happened. And then as deposits started getting withdrawn, and the bank was still doing lending, you got into what was a sort of classic bank run. Nothing immoral or illegal, in my view, happened. It was just a really silly, stupid, unfortunate decision at the top of the house that ultimately led to the institution cratering after people sort of figured out that there was a sort of financial potential for financial crisis in the company's sort of bond portfolio, or in the bank's bond portfolio. SVB in the US in particular continues on as part of First Citizens. Some of the great people that were at the firm have stayed on there. In fact, most of them have. It is still the plurality player. I wouldn't call SVB quite the 800-pound gorilla it used to be, but it's still sort of around and doing lots of great work. There are, however, some people who left, and there's a number of SVB alumnus who went to form or reinforce or really bolster existing innovation teams. So the likes of HSBC started a whole new practice focused on the innovation ecosystem. They also bought the weekend of SVB's failure, the UK and basically European operations of SVB for one pound, and then have a US practice now. Stifel, formerly mostly an investment bank, people would know, but that's got a great group of SVBers. A bunch of other people went to JP Morgan, some other places. And then private credit, not so much because of SVB's failure, though it certainly contributed a bit to it, but just the interest rate environment changing and the amount of capital that companies want to borrow have led both to a bunch of new banks playing in venture lending and innovation banking, and private credit's participation in this industry has never been higher. So there is more firms in general of both types providing capital to the startup ecosystem than there ever have been by like a step function, both number of players and also dollars available. Average deal size also way up over the last 3-4 years. So as an entrepreneur, that's a very good thing. I don't know exactly where that goes from here. I got to imagine sort of like venture capital, I don't know that all those firms, private credit and banks, are going to stay in this industry, because right now, if you're an AI company, money's falling out of trees, hitting you on the head, and there's all kinds of gobs of new funding announcements every day, but that doesn't go on forever.
Right.
And people are going to have to grapple with, do they want to stay in this industry, both if they face real credit risk or loss of potentially dollars they've lent, or for private credit more than banks. But as interest rates potentially keep coming down, the yield you can get on private credit structures is going to reduce. Therefore, some private credit firms might say, this isn't quite the fit for us, or we've got to go somewhere else where we can get a better risk-adjusted return.
All right, last question. It's more of a scenario. I'm glad you're sitting down, because it's the most important question I'm going to ask you today. Maybe for you for the year, because it's kind of close to the end of the year. It's more of a scenario. Marshall, you're on a desert island the rest of your life. You have food, you have water, you have everything you need, even healthcare, let's say. You have everything you need, but there's one thing missing. That is, there is no entertainment at all on the island. But luckily for you, an old 80s boombox drifts ashore with unlimited batteries. But you can only bring one album to listen to the rest of your life. What album are you going to bring?
It's got to be from the 80s.
Does not need to be from the 80s, be any era. It just happens to be an 80s boombox. Let's say it can play any type of format on it.
It goes back to I grew up with an older brother, and my dad both were fans of this band. And I sort of became a big fan over the years, less of these days because it's just less active. But U2, the Joshua Tree is probably what I would bring with me. I feel like that's one of the better front to back albums that I would like. I like lots of other artists, but that's the one.
That's a good one. That's a real good one. There's not one bad note on that album.
It's a pretty good one.
The back. Wow, that's a really good answer. I love that. It didn't take you very long, and you answered that pretty easily. So that's good. I like that.
Hey, go with your gut. When you're going to be on a desert island stuck for a while, just go with the thing that you think is best.
Well, that's awesome. I appreciate the conversation. Where can people tell us when the book's coming out, where they can find it, and all the good stuff on that?
Yeah, thanks, Jeff. Venture Debt Deals will be out in sort of all formats: hardcover, Kindle, or ebook, and audiobook, read by yours truly, for better or worse. January 20th, you can buy it sort of anywhere books are sold. Also, my own site, venturedebtdeals.com, will get you anywhere you want to go, tell you a little more about the book, what's in it, who's involved, and whatnot. And excited to see it get out in the world.
That's awesome. I think it's going to be a hit. I think it's a book that needed to be written. I'm glad someone finally wrote it, and knowing you, I'm glad you wrote it. So I'm excited about it, and look for the book. And thanks again, Marshall, for being on the show.
Awesome. Thanks for having me, Jeff.